Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
Today we have a packed lineup from India's financial markets, digital lending expansion, major bond issuances, infrastructure financing, inflation concerns, and strong activity across the corporate debt space. Stay with us as we break down the biggest developments shaping the economy and capital markets.
Absolutely, Vijendra. Let's begin in the Northeast, where Northeastern Development Finance Corporation Limited has partnered with VFin Solutions Limited to launch a cloud-based digital lending platform that will streamline loan origination, management, and collections across the 8 states of Northeast India. By integrating banking APIs and credit bureaus, the platform enables entrepreneurs and MSMEs in remote regions to apply through mobile devices and access real-time account information, significantly improving financial inclusion.
And strategically, this move supports sectors like healthcare, tourism, and manufacturing, while expanding NEDFI's lending products, including working capital revolving loans. VFin software reportedly meets nearly all operational requirements, making this a scalable long-term solution aimed at modernizing credit delivery and boosting regional economic development.
Staying with financing trends, Kotak Mahindra Asset Management closed its inaugural private credit fund at over Rs 2,000 crores, reflecting strong investor demand for alternative debt financing. The fund targets mid-market companies looking for customized financing solutions as banks tighten lending due to non-performing asset concerns.
That's part of a much larger shift. Private credit funds in India are now offering expected returns of 16 to 18% per annum compared to roughly 9 to 11% from traditional bank loans. While the sector carries risks like illiquidity and long lock-in periods of 5 to 10 years, the Indian private credit market could potentially grow to $250 billion by 2030.
Moving to the debt market now, Unifin's Capital India Limited allotted 35,000 secured non-convertible debentures worth Rs 35 crores through private placement. These carry a fixed coupon rate of 13% per annum payable monthly and matured on April 23, 2028. With a BBB- stable rating from CRISIL and security backed by first-ranking book debts, the issuance is aimed at investors seeking higher regular income despite moderate credit risk.
And listing these debentures on the wholesale debt market segment of PSE improves liquidity and transparency while maintaining compliance with SEB regulations. The issue also includes additional interest penalties in case of defaults, reinforcing investor safeguards.
Let's now turn to digital lending, where India disbursed personal loans worth Rs 97,381 crores in the first half of fiscal year 2025 to 2026, marking a 25% increase year-on-year. Interestingly, digital loans now account for 80% of personal loan volume, but only 19% of loan value, showing strong focus on smaller ticket loans.
Exactly, and much of this growth is coming from younger borrowers under 35 and Tier 3 towns, which now account for nearly 39% of loan value. The Reserve Bank of India's digital lending guidelines introduced in 2022 have tightened transparency norms through mandatory key fact statements and direct fund transfers, while overdue loans beyond 90 days have improved to around 2.1%.
Even with improving asset quality, concerns remain around over-indebtedness and data security. But the increasing participation of traditional banks in digital lending clearly shows how fintech lending is becoming mainstream in India's credit ecosystem.
Now to banking and liquidity pressures, Indian banks are targeting corporate loan growth of 12 to 15% in fiscal year 2026 to 2027, driven by infrastructure, renewable energy, and data center financing. However, deposit growth continues lagging at around 9 to 14%, forcing banks to rely more heavily on expensive wholesale funding.
That's creating pressure on liquidity coverage ratios and squeezing profitability, especially for public sector banks. Rising crude oil prices near $105 per barrel could also push inflation toward 5.6% and trigger additional repo rate hikes, increasing funding costs further while slowing economic growth.
Adding to that challenge, foreign investors have withdrawn nearly $22 billion this year, reducing foreign ownership to multi-year lows. Public sector banks remain under pressure while private banks like Axis Bank continue expanding aggressively in corporate lending.
Let's move to capital market activity now. MK Global Financial Services plans to raise up to Rs 100 crores through private placement of non-convertible debentures, while Mankind Pharma received reaffirmation of its AA+ stable rating for debt facilities totaling Rs 6,250 crores, along with an A1+ rating for its commercial paper program.
Those strong ratings reinforce Mankind Pharma's ability to access funding at competitive rates, despite regulatory risks and rising raw material costs. Similar trends are visible across the pharmaceutical sector, where firms increasingly rely on debt markets to support expansion and working capital management.
In the bond market, Bajaj Finance accepted bids totaling 28.92 billion rupees across two issuances, a fresh 5-year bond carrying an 8% coupon and a reissued bond maturing in April 2029 with a 7.95% yield. Both are rated AAA by CRISIL and attracted very strong investor demand.
Bajaj Housing Finance and Mahindra Financial also raised funds successfully through AAA-rated issuances, highlighting continued appetite for high-quality corporate debt despite ongoing market volatility and rising yields.
Meanwhile, the Export-Import Bank of India plans to raise nearly 995 billion rupees or $10.5 billion in fiscal year 2027 through domestic and international borrowings. However, geopolitical tensions in the Middle East and disruptions around the Strait of Hormuz remain significant risks to borrowing timing and export growth.
State Bank of India is also preparing to raise up to $2 billion through overseas bond issuances in fiscal year 2026 to 2027. This follows strong financial performance, including a 13% rise in net profit to Rs 80,032 crores and improved asset quality with gross non-performing assets falling to 1.49%.
The international fundraising gives SBI greater flexibility to access global liquidity through fixed or floating rate issuances under Regulation S and Rule 144A structures, strengthening its position in overseas debt markets.
In another pharmaceutical sector update, Sudarshan Pharma's board will meet on May 15, 2026 to approve foreign currency convertible bonds after earlier shareholder and exchange approvals. The company aims to diversify funding through foreign currency borrowing, though regulatory approvals and conversion terms remain critical risks.
Meanwhile, India Ratings reaffirmed Philatex India's bank facilities of Rs 998 crores at AA- stable, while Ugro Capital issued commercial papers worth Rs 134 crores to strengthen liquidity amid rising interest rates. Nexus Select Trust also fully repaid its 600 crore commercial paper program, leading to withdrawal of its highest short-term rating.
Inflation is also back in focus. India's retail inflation rose slightly to 3.48% in April, due mainly to rising food prices, while the rupee weakened toward 95.6250 against the US dollar. Higher crude oil prices and fears of a weak monsoon are increasing imported inflation risks and limiting the Reserve Bank of India's flexibility on future rate cuts.
And in the power sector, Torrent Power posted consolidated profit after tax of Rs 2,469 crores on revenues of Rs 29,165 crores for fiscal year 2025 to 2026. The company also plans to raise Rs 10,000 crores through non-convertible debentures while maintaining strong shareholder payouts through dividends.
In infrastructure and real estate, Indus Infra Trust plans major fundraising through commercial papers, debt instruments, and preferential allotments while retaining its highest AAA stable rating from India Ratings. At the same time, Parshavanath Developers has entered corporate insolvency resolution process over defaults exceeding Rs 452 crores, highlighting continued stress in parts of the real estate sector.
Finally, investors are increasingly shifting towards shorter duration corporate bond funds, offering yields between 7 and 7.5%, providing better accrual income compared to traditional bank fixed deposits. With interest rate uncertainty, inflation pressures, and geopolitical volatility continuing globally, defensive fixed income strategies are gaining traction across Indian markets.
That's all for today's edition of the DebtCircle podcast. Stay tuned for more sharp insights, debt market updates, and in-depth analysis from the world of finance.